Hello, everybody, and welcome back to the Property Hustle Show. My name is Andrew, and today Ping and I have two very special guests and old friends of ours, Roland and Fatima from Rolima Financial Group. In today's podcast, we're going to be talking about a plethora of things regarding mortgages. We're going to talk about how mortgages are in Canada, where mortgages are heading for Canadians shopping in Canada, but also for those of us investors looking to invest in the U.S., what investment options do we have as they are also expanding into the U.S. market and creating specific products for us to use. So guys, great to have you on the show.
Thank you.
Thank you for having us, and it's a pleasure to see you guys, and we're so excited to be part of this podcast.
There are a lot of Canadians right now who are even for investment option are looking at U.S. investing.
Yeah.
And I think some of the bigger questions that people have revolve around mortgages, right? I know you guys are also shifting into the U.S. mortgage space.
Yeah.
Right. What are some fundamental things that Canadians might need to know if they want to purchase property in the U.S. mortgage-wise?
Okay. Simply in U.S., basically, they go straight to the bank. In U.S., they're not going to give them normal criteria. How we treat U.S. citizen in Canada, they don't treat us in U.S. like that. Here, if they come in U.S. citizen comes in here, we treat them as a Canadian, as long as he has an income or whatever. We just take our same application that I take from you. But in there, no. We have to have a 35% down payment. You have to have a good credit. That's a bank. There are other roads that we can go with. The minimum down payment of 20 to 25% down payment as a Canadian with no income and with no credit history, as long as you have 12 months of, let's say, rental agreements or telephone bill or something.
Okay.
You can purchase a house in U.S. or property. As if you want to rent it down there, has to cover the mortgage payment as well. And you can do it by two things: up to $1 million under corporation name, or $2 million under yourself, under your own
Personal name.
So even for the 20 to 25%, that can be done under corporation, because a lot of Canadian investing in the U.S. want to set things up in a way that there's an LP, limited partnership in there, so that we can avoid the double taxation. So that can be done.
Yeah.
Up to $1 million, right?
Yeah, up to $1 million, yes. For under corporation. Plus,
And the P&I, they have to have a reserve.
Yeah, if they want to pay it off.
Yeah.
Yeah, but 6 months principal and interest payment, you have to have it reserved, by the way. On top of that, you can actually rent that property, even for a short period of time. Just rent it to make sure that that rental income is covering the mortgage.
Yeah.
And the rates are like same as today's Canadian rate, basically.
6 to 7%.
7 to 8%.
7 to 8%.
Yeah. Except that, as Andrew said, there are 1 year, 5 year, 1 year, 3 year, 5 year, 10 years, 25 years, 30 years locked in mortgages. Or you have adjusted rate mortgages as well. They're on, they call it. Simply, same thing. If you want to break the mortgage simply, you pay 6 months, if I'm not mistaken. I have it in those, I give it to you there. 6 month interest. And then 80%, the remaining is just, I believe, 3 to 4 months of penalty. Let me just make sure that 80% of remaining balance.
And that's
6 months.
And that's relatively standard. It's not when you do the 5-year lock here or 3 or 5-year lock
it
here,
doesn't work
the
the
fees
same
are
way.
astronomical.
Yeah,
Right?
no.
So
Down there is basically United States except New York. State of New York, it's different rules. We can get you mortgage anywhere, even in Alaska if you miss the cold.
Right. So what's the criteria here? Because a lot of Canadian investors are going down there. They sometimes people wanting to know, the lenders wanting to know their credit score, their payment histories, and all that stuff. What is the criteria here? Or there's no criteria at all?
There's nothing here. These are from the contacts that we do have. We have dealing with in U.S. is simply they are like us, brokerage, which they deal with 93 different A, B, and C banks. Simply.
Mm-hmm.
So this program that Roland is talking about is specific to the Canadians who are...
Yeah, we just basically, this is actually advertised only for us, by the way.
Okay.
For us.
This is the Rolima specific program.
Yeah, exactly. for us, yeah. This is 93 banks approve this, and we just put them together and you send it to me simply.
You mentioned 12 months of phone bill.
Yeah, if you don't have any credit.
Yeah, within the U.S.
In here.
In Canada.
Canada. Oh.
If you don't have
Yeah.
If
any...
you don't have a credit score, let's say no FICO score.
Really, in terms of proof of funds, a lot of lenders over there will want to see, okay, you have the proof of funds for 30 days, 60 days, 90 days, depending.
No.
Nothing like that.
Foreigner, you have to be in U.S. to sign the only thing.
The down payment, you're referring to the down payment?
Down payment,
Yeah, they have to show it.
From your Canadian account, has to go on in U.S. account.
Last deal when we did it, we just had to show the funds.
Nice.
I mean, that was a different. They didn't even ask for income, although the client was the covenant was very strong, but they didn't. So,
But him was, if you're talking about the doctor, he was his mortgage was through a private.
yeah.
These are banks.
Okay. Sorry, I still want to be a little bit more specific because it sounds like people can just apply, get a loan like instantaneously without being checked on their portfolios and all that stuff.
Only your client. Only your client.
Check
They can go in there, yeah.
basic stuff, right? It has to make sense. So
Okay.
the down payment has to be saved, their own legit down payment. Type of
Okay,
thing.
got it. Source of funds is still important.
Yes. So
Yep.
source of fund, that is
Yeah,
standard
but then
anywhere
you
go,
tell
right?
tell
So-
them that you are Canadian, you're bringing Canadian, you're obviously going to show.
But it's not sticky as
Got it.
income qualified.
It's not income
program.
qualified.
Yeah, you still gotta. There is due diligence done.
But instead of income qualify, you have to qualify with
P&I have to
rent.
rent.
I
To
see.
make sure that the property is, if it's rented, that the investor or the bank or whatever lender wants to see if I rent this property will cover my mortgage payment.
Okay, what about this? Let's say if somebody wants to go and buy a property and do some improvement in order to lift the rents. And I know that a lot of American banks have products that take into consideration the renovations that you're going to do and then the leases that you're going to attain in the future. Because some properties, unless you're buying a turnkey property with leases already in place, you can buy turnkey cash flow properties that will pay for everything, and that's fine. But would this apply to if somebody wanted to do value add?
Yes, you can. You can actually. This is simply is for investment property. Investment property is if you afford it to pay monthly payment without somebody's renting it, go ahead and keep it for as an investment or whatever. But this is simply the program that we have for Canadian. It's just basically you are renting it there. The rent could be 6 months, could be 6 days, could be 6 years. So as long as it's saying that it's renting, I'm renting the property. Simply, it's for rental property.
Yeah.
But it's if you're looking at doing renovation, for instance, to just upgrade it, it'll be the future value, right? So it's same.
And future value is
It'll be based on the future value.
future value.
So that is doable. I mean, this is holistically the program, but every client situation is
Still going to be different.
is going to be different. There's the ones that is going to go in and not rent it. It could be for personal use, but it's good the way it is. Or the ones who would like to actually rent it, or would like to do some work before they get in. So there is in that situation, it'll be on the future value.
Is there any restriction on the property type? Is it only going to be applicable to anything under 4 units, or anything above 4 units can also work? Because some of the markets I would look into, 12-unit building, 16 or 20-unit building.
Down payment will increase.
Yeah, for sure. Okay.
Yeah, down payment from 25 will be probably 30.
35.
Yeah.
Got it.
Yeah.
Okay.
That's for same, like even these client that we have, even this customer that we're talking about, if they have, let's say, if they have a Visa card in U.S. bank, the rate will change, go even lower, because they established credit with the U.S. banks, right? So if they have or work permit or visa permit or something to work there, the rate will be even, like they will treat you differently. This is strictly for investment to start up a business, to start up an investment in U.S.
Got it.
It's just simply for that. Just it could be a $300,000, $200,000 mortgage house, or it could be
It's down payment driven, really.
It's just basically investment as an investment.
Are there minimums, like whereas I know some lenders we're talking about only willing to lend in this manner if you're purchasing a property over, let's say, $200,000, or they have certain like mortgage minimums.
1 million is
Maximum.
maximum if it goes under the company name.
Yeah.
If 2 million under personal name.
Okay, these are the maximum, but there's no minimums, right?
No
Okay,
minimums.
so like some people who are looking at $100,000 properties, it's like they can still do that standard.
I don't think
As long as you can rent it, if you find that property.
I don't think we came across anyone buying for 100,000.
That may be an extreme example, but let's say 200,000. Like, I just wanted to see if there are minimums, just so people to be aware.
There are a lot of states actually. Their houses are like that.
I know.
250, 300,000.
Texas is.
Yeah.
You know?
No, I know. Honestly, we've been looking a lot at Cleveland, and there are cash flow positive properties turnkey that will work at like 150 to 200,000 with room for value add and lift on rents too. Yeah.
Yeah.
So
those are like You don't even need a mortgage. You can use your line of credit.
Yeah.
Yeah.
You can use the line of credit. The good thing is that there is opportunity on both sides, and the other side of the border, we do have partners that we work with, and there are programs available specifically for Canadians, that's good news again. Like anything that helps investors generate more income, right? So opportunity on both sides of the borders, and we do have also the ones who work across, right? Like
If they want to come
like
in.
Windsor, for instance, they go across, right, to work. They think also of buying there. They reside in the other, like on Canadian soil, but they go there and they say, oh, you know what, I may get a property and I'm gonna rent it, right? So it's this is the beauty of this business, is always an opportunity, and the partnerships, they work in such a way to provide solution for these types of clients, for sure.
So how would you guys have? What kind of clients you guys are looking at? Like maybe we can send you guys some clients too.
Oh, a lot of the clients and members in our program right now, what they're looking for is really just a cash flowing properties, because it's almost impossible to create that here in Ontario. So people started looking for an alternative market, and really, like, when you're looking at U.S. market is like pretty large, right? And then every state has a different regulation, but right now what we find that more and more people are finding very interesting, intriguing for them to pull trigger is in Ohio, because it's only 45 hours away from a GTA, much closer.
4 to 5 hours.
4 to 5 hours.
5 hours.
Well, what did I say? I said 45. 4 to
I was
5.
like,
Sorry.
let me check my geography.
Yeah. 4 to 5 hours away from GTA, and then a lot of properties that we're looking at duplex, like a custom built duplex, is actually around $200K in B-class neighborhood. It cash flows from day one, so that's a becoming more and more popular asset class that we're looking at right now.
Yeah, those are nice. If if I have a client, if we happen to have, we can send you guys a referral for.
No, yeah, honestly, because there's questions that people have when it comes to how to set it up and how to make things work, and even as an investor, how to manage your property. A lot of Canadians are thinking about it not necessarily to live in, but for investment purpose only. In speaking about like how some people are going over to the U.S. So for people who don't want to geographically go too far, and a lot of people feel comfortable with tangible property, it's nice to know that you could drive there. I mean, we see people driving out to Timmins or Sudbury. Let's talk a little bit about like who's your bread and butter, because like obviously you serve a variety of clients. You serve clients like myself who were getting into real estate and obviously building out, and you still do. I think a lot of the questions that people have has to do largely with the differences between like, you know, private and A-lender banks, right? It seems like in between is not as popular, like the B lenders. Would you say like it's more popular, less popular? How would you rate them in terms of like private A lenders and then B lenders?
Yeah, you're giving me this. Well, it's really, you know, in Canada, they like to label things A, B, C, D. It's really not an A or B, C. Like, it's just a solution. As you said, there is a solution to a situation for a client who's seeking a mortgage. But if you look at the difference between the criteria, you know, I mean, I call it, there is a premium to each program. If you're referring to the A or B, they are banks. Like, they're federally, regulated. They are registered as banks. They follow the Bank Act, so there is no concern there. It's just the guidelines, the risk that lender will take. Right. So that's why they classify the A and B without going into too many technical stuff. But when you talk about financial institution, the red bank or the green one or what have you, you know, they work off deposits and credit, right? So their balance sheet is different versus if you go to the B lender, it's more heavily focused on the lending, like the mortgages, but also the way how they insure their mortgage
investment
book, right? So the way I would simply describe it to someone just like not knowing anything is just, you know, there is a premium to each risk. So if you are clean cut, qualified 100%, you're on pay stub, your income supports the loan, that's when we say the A lender. If you're having in between, such as maybe you're self-employed, maybe you're not T4, so there is a different way to look at it. Mind you, banks look at that too. Like on the A side, the higher the risk, the higher the rate, right? That's why we label it as there is a premium to each program. If you look at the private, it's a completely different, beast.
That itself on both.
Also, there is institutionalized private. They're more structured. And then anyone can basically lend, if you have money and you want to put it out there and you want to lend it, that's an investment and get a return on investment. You can do that. But as us brokers, if we're involved in that space, say you come and you want to invest your money with us because you want to lend it, well, we still want to make sure that you are qualified. Because you don't want to put all your savings in lending and then you're at loss. So it is regulated provincially. When we speak about the private space, it's regulated provincially. Just like any other area, like RSP, mutual funds, you name it, insurance, it's exactly the same way. But the higher the risk is, the higher premium, I call it. I wouldn't call it the rate, but the premium, you got to pay a little bit more to have access to that. And really, when you think between the whole goal for us as brokers and the solution for our clients, because you want to put them in a better off situation. And you're a perfect example, Andrew, because once upon a time, you couldn't qualify with a bank, but there is a roadmap, right? And it's a plan that's between the broker and the client. You basically follow the plan, right? So yes, you may start private and then there will be an exit strategy, right? Private lender is not a forever solution. It is a temporary solution. It's a bridge and a very, very short bridge. So we have to have a plan in place. We have to have an exit strategy to actually take you to the next step. It may be straight to the A side or it may be to the B side. But you asked a good question. The B in between is not much. Probably in the last year, just because of the way interest rates are, we almost see no difference between the rates that are offered by the A versus B, right? It's challenging when you apply the stress test and you try to qualify a client. That is a challenge. But we've seen a little bit of, in the past year and a half, I would say it's either you're on the A side or you are on the private side. The B side was a little bit difficult because almost it falls to the same qualification. It still relies on debt service ratio and all of that stuff.
Yeah.
And on the private side, it also changed because of what's happening in the real estate market. Values have dropped. The risk became higher. So even the private lenders, they were generous, lending 75% of the value, with limit to 65%, for instance. And they're becoming more geared to look at the deal, not as an equity lender, but as, okay, does the client qualify? How are they gonna, although you have an exit strategy, they're still looking for how are you gonna support the income, which always been the case, but it's more tighter than how it used to be. And it's very understandable because an investor wants security on their investment. Quite frankly, going through, someone not paying their mortgage and having to take over and sell their property is not an easy process. It's costly, emotionally draining as well on both sides. Anyone in this business is in it to win it, not to lose. So the landscape has been different in the past couple of years, but I think we're coming out of that slowly. Yeah.
She can tell you the whole book.
No.
That's the upper management.
That was really
it's
robust.
just the view on what's happening.
No, by the way, I think you illustrated it correctly, because even when we talk about private lenders, sometimes people think that it can be a guy, it can also be institutional, right?
Yeah.
The vetting process being different from back in the day versus what it is now. I remember, for example, when you introduced me to the private lender, it was more like a conversation. We shook hands and that was the vetting, right? And that was much different. Now, as the lending industry matures, people have different experiences. We understand the Canadian market, even the private lenders. You would see groups like Calvert, I think. A lot of people have dealt with Calvert, and it's interesting. We would consider them private institutional, right?
Yes.
So if they're private institutional, some people will notice and have said that when they have the vetting process, they will have conversations as if though they're a partner in the project.
Exactly.
They're asking questions that a partner would be asking you sometimes about your process. And so different people will have different vetting processes, especially in the private sector, that aren't so formal as would be an A-lender or bank.
Yeah.
And also lately, government interferes more, basically. Just they want to know what's going on with I'm thinking of it as a positive thing, which is sometimes is very good, because we used to hear a lot of horror story about that private lender took over somebody's property because he missed the 2 payments. He had those ones too. But these days, no, they're more regulated. They're more FISRA is actually all over everything.
Yeah.
So private is actually part of our mortgage industry these days, actually,
It
private
is.
lending.
It's a necessary part, especially today. I mean, you start to see articles in the news that talk about how mortgage delinquencies are increasing dramatically. I think it was like, it was 100 and something percent, like over 100% increase
Yeah.
over the last year, I think it was. In Ontario alone. It was less in BC, but in Ontario, they've increased quite a bit. And we see other articles how Canadians are using debt to cover debt. So on one hand, they say that, yes, mortgage transactions went through a decline, right, where mortgage sales were done. So it's like transactions were less, but also refinances were less.
Yeah.
But a lot of people were reportedly going to private mortgages, which actually I feel like, do private mortgage register in those statistics?
Yeah.
They will register, or?
Yes, they would. I have to just say something about this.
These are news articles. These are
Yeah, I know. You see what happened when the stress test was introduced. The actual interest rate or the contract rate was very low, which makes sense. And this is just my opinion, and I'm not representing anybody or anything. It's just my personal opinion. When you apply a stress test, and that is a way to mitigate, right? So basically, you're taking it in case if the interest rate goes high, the client should be able to still qualify or carry the mortgage, right? Just for the sake of giving examples, let's say the rate was back then at 4%, that's the contract rate, and now you're adding a 2% buffer as a stress test. So I am decreasing your purchasing power because I'm qualifying you on 6%, right? So if I qualify you on 6%, you're good based on your income, you can carry that payment with no issues, but I've decreased your purchasing power. Fast forward to COVID era, rates have dropped. So we've seen 1.99%. You add the 2%, which in my opinion, that should have applied during the COVID time, and the stress test should have been higher than 2%, the addition. So now you're 1.99, I'm adding 2%, that's 3.99. Yeah, it's all good, And we know what happened in 21, and it was just because everybody started moving out of the city, downtown Toronto almost became a ghost city because everybody now is working from home. They get to enjoy. People didn't get a chance to get out of Toronto, for instance, until the COVID time. And then they start discovering about all these small pockets outside of Toronto where, the commute is not bad, but that was like COVID time. Of course, the driving and the commute is not that bad, right? And I'm going to work from home. So I'm decreasing my expenses because I can work from home. I can afford this house, right? So now I'm qualifying you on 3.99 because your contract rate is 1.99. Great. Well, 5 years later, it's up time for renewal. I'm not even talking about clients who refinance. This is just time for renewal. Let's say that client's been good with their mortgage, finances, everything in check, 1.99 year rate. Now you're up for renewal. What are the rates today, Roland? On a regular bank rate, pick for instance a 5-year fixed.
579.
579, right? So you're coming from paying 1.99. Let's keep in mind you were qualified on 3.99. Your income is good. But now you're coming out to where? A time where rates are 5.79, for instance, and I'm adding another 2% if you even think to go somewhere else to shop for a rate. I have to now qualify you based on 7.79. I mean, it's just insane. Your income has not changed. Of course, these clients went to borrow and get a private. It's not just about the mortgage, it's about the cost of living has gone up too. You have a family, you need to look after your kids.
Yeah.
So, I am at an awe with how the government has driven this because, yes, they did it for a purpose, but again, a lot of, Canadians are suffering because I didn't do anything. I kept my mortgage the way it is. I paid it the way it is. My income did not change. Now I have to pay 5.79 from 1.99. My income has to triple to be able to carry that cost. Plus, I have to carry the current cost, which is the cost of living has gone up. Plus, now 5 years ago, I didn't have kids. Now I have 2 kids. plus, right? So really, really, it's tough time. And this is why a lot of Canadians went the route of private mortgage because they thought, you know what? Okay, I use my credit facility. Now I have all these payments, credit cards, lines of credit. Let me consolidate. Let me refinance. Guess what? You can't qualify for 2 reasons. Your income is not sufficient. 2, the value of the property dropped too. So now what do? I'm going to go private. And that private cost is even higher. So whatever potential equity that I've been sitting on is gone like this.
Yeah.
So this is the true picture of what's happening today. That's one pocket. But there are others who actually there's opportunity in chaos. They did well as well, right? So it's like you have both worlds.
I love what you said because now it's a good place to bridge into several things that I think people also want to know about. One, while this is a good reason why people are looking to private mortgages, they're essentially trying to buy time. A lot of people who especially went out of Toronto, they effectively overpaid for certain properties because of the competition and everything. And the mortgage says just made sense at the time. And now they're paying for it. Some people who locked in at low rate, hopefully they can skip like the 5 years if they locked in at 5 years. And then maybe we're in a recovery road, which now with the recent interest rate drops, people are optimistic that we're in a recovery trajectory. I would love to hear your opinion on that. But also, I feel like this also segues into why a lot of Canadians, especially when it comes to mortgage options, are even looking at U.S. options. Because a lot of people who bought in the U.S., they have the 25-year, unlike the Canadian market where you have your 3 or 5 year renewal periods, where there is like 25, 30 years, right, depending on the product that you buy. And even right now, a lot of people are looking at U.S. products. So let's talk about these things first. I feel like the first one is people essentially biding time to get debt.
No.
Yeah, and they started to look outside of Canada.
And they started to go there. So what I want to know is like even politically, Trudeau is talking about extending amortization periods for first-time home buyers up to like 30 years to help alleviate them. And there's other things that they're putting into place, like the charter for lending and the qualification criteria, not needing people to requalify if they're already paying their mortgages.
Yes.
Do you think that these are making effective change for Canadians, consumers, and homes and mortgages?
Temporary.
The very first question was, what's your thoughts on the rate coming down? How's that going to affect the future real estate market, like let's say in the next like 6 to 12 months? Yeah, like what's your take on that?
History, if we go back since we met, gonna drop the rate. It's gonna help a little bit, but we will be going, let's just be honest, like they pull all the money from people's pocket, from people's equity of the house. There's no money left. If government didn't do it on its own, they did it by the banks, by the credit cards, by the private lenders. So there's no money left right now. So it will take maybe 2-3 years. The price is going to go slow up, simply. And then maybe again, when people got used to it, they're going to start getting paid higher and more, and the price is going to go up again. But it will be going, my opinion is they're going to go small up, like they're not going to have a big jump.
Yeah.
And as you said, they're buying a lot of properties, people thinking, because if I'm buying a house, let's say I used to live in Richmond Hill, now I live in Cookstown. The difference between Richmond Hill and Cookstown, even if it's a smaller house and bigger house in Cookstown, you can't compare them basically. The prices are it was cheaper and it was affordable back up there. But right now, same thing in same neighborhood. The guy I've worked 2 jobs. My wife works, my kid works. I cannot afford the house that I have in Richmond Hill, so I have to just go somewhere cheaper, simply. That's what they did. So this is my opinion is the dropping of the rate, as you said, Mr. Trudeau, even if with his pay stub, he won't qualify for $1 million mortgage rate. Remember,
$1 million right now it's
280,000, 300,000. Remember the first day I met you, I said for
income.
Yeah.
Income.
Standard 20% down, right? Like
$1 million mortgage amount, which
remember
would be
the first day we met, I said for each 100,000 you need 20 to 25,000 income.
Yes.
Right now that is 30 to 35,000 income.
Every 30, 35 gets you 100,000.
100,000.
Okay, so for people right now, I think entry-level homes are like in and around $500,000. Like we're talking about further
way
out.
far.
Yeah.
Way far.
We're talking about like Welland and some other places, right? Like $500,000. So that means that
minimum 150,000 income.
Yeah, 150,000 income to qualify for one of those loans collectively.
Yeah.
So
even if it's 30 years, what they do, and they just putting a Band-Aid on a a huge surgery spot. They're not sewing it.
Yeah.
They're just putting a little bandage. Like 30 years, we used to have a 30 years. Still, except CMHC once, they were 25. He's increasing that 25 to 30 years.
On the new constructions only.
Only on the new construction, by the way, not on everything else. Not on existing.
New
Yeah.
product only.
New
Okay.
product.
Just
Yeah.
new construction, new
Yeah.
builds.
See, they're trying to sell the houses that they basically selling for the votes, basically creating project outside, basically simply that's what they're trying to do. They're trying to sell those high-rise buildings that they're building, promising for getting extra votes, I believe.
Well, let's just, it's not a pessimistic, it's still optimistic. It's a crisis that everyone is I think the whole world is going through a crisis. Let's just face it. There is war, there was COVID, there is recovery on every aspect.
It's been a roller coaster.
Yeah, it's a roller coaster for everybody, and people are tired, even mentally. They are exhausted. The Canadians start looking to go outside because they need a change. Everyone is looking for a change, right? And the other side of the border looks promising because this is the closest side. But we know so many people who've gone buying in.
They exist.
We see like Europe coming here, and we see people from here going back to Europe, and we see again the new fresh incoming from other countries, and we see also the students who are here now becoming, residents. We see the ones who came to just check it out and they got a work permit and they're working and now they want to become residents. So all of this is going to come out in a couple of years in a good way because we know that Canada is behind in providing homes, right? So that's why
They're short.
we are short. There's
Oh, yeah.
shortage. Toronto is saturated. Like it's so ridiculous when you see a little piece of land that has a little house and it's worth 2-3 million. I mean, not any it takes a special one to qualify for that, right? But the average one who's a professional and coming fresh from school and they have a job, very good, well-paying job. Is not like they're making the other day an engineer making $180,000, but it's still tough to qualify for
800,000.
800,000 or it's tough.
Because it's not just a mortgage. It's you have a credit card, you have a car loan,
You have your cost of living.
cost of living.
Yeah.
Have you been in McDonald's lately? I'm sorry, McDonald's used to be $3, $18.
Yeah, it's getting
Yeah, so the cost of living has gone
I
high,
was just what the
but the wages are still the same.
Yeah, so the question here is who the heck is buying the houses right now?
Yeah.
Investors, but
Everybody.
Investors.
are
Yeah.
investors. As I said, we're
Only investors, single-family homes?
Yeah. No, you know what? Like as she mentioned, there's a good side and there's a bad side.
Yeah.
Remember, you used to everybody. I remember my kids growing up. I want to get out. I want to get out.
Yeah.
No, Daddy, I'm coming in.
No, they all
No,
want
coming
a
back.
family reunion.
Just
It's happening
positive
now.
thing, like brothers together, parents and kids together, friends together. They're buying houses right now, like it used to be. But still, there is a hope, right?
Yeah.
So we just living off of this mortgages. Our job is mortgages. I'm not saying all negative things, but
No, yeah.
there are positive. There are ways of still getting approved by the mortgage company, by the banks, by the lenders. There are.
Well, a friend of mine said this very interesting thing where he's just like, yeah, no, the great thing about living with family all together is just even if everybody's working a minimum wage job, let's say everybody's working at Tim Hortons, how many people working at Tim Hortons do you need to put together
Yeah.
to buy a house?
Yeah.
Because you said 35,000 per 100. So if
Okay.
one person's making 35,000 and you need an $800,000 mortgage, you need 8 people,
Yeah.
8 incomes
Yes.
combined.
Yes.
Yes.
Yeah.
To buy
And
one.
mostly you guys are mostly in construction too. I suggest whoever you're gonna work with, this is a message. Make sure they have a side door, basement, finished basement, and a side door with the kitchen.
For the kids or for new tenants?
No, for the new tenant, because
For the-
that gives you an income.
Yeah.
Yeah.
That considered as income for the new buyer.
Right.
Yeah.
So are you seeing that the majority of the buyers right now on the market are investors? Or
no.
more like
No.
Everybody
Everybody.
Still everyone.
Yeah.
Still everybody is there. Yes, it's hard to get them approved. It's hard, but again, we just tell them, just bring in your mother, your father,
Yeah.
your somebody.
Yes.
That's fine.
Yeah.
There are still the same, there are a lot of first-time home buyers,
Yeah.
right? Because we're having an influx of newcomers
hot
too.
roll.
In the $2 million price range?
They cannot
No?
afford that.
Okay.
The what we say newcomers or new immigrants, some of them are already established here because they've been
They come with
studying
the job
and now
already
they're,
in.
or some are migrating because their jobs have been transferred. So those are first-time home buyers, and they're not looking at buying 1.5 million. These are ones who've been established in wherever they came from, and they're coming here for a purpose, right? Either they have young family, they want their children to grow up in Canada, go to school in Canada, for instance. So they're already established. Income is not an issue, and they have, they sell their assets or they bring some money, but it's still, they look at below the million, right? Like the which is the reasonable purchase, basically, and they want to put 5 or 10% down. That's what they have, and they're going like very financially. They're very well structured, and it's still difficult to find the property for them because how many properties we find below the million in GTA?
Yeah.
Right? And even if you find something below the million, say for instance a condo, right? But your maintenance fee is almost like a mortgage payment. Now this is happening on the new condos. Before, the old history had it that it's the older the condo is, the higher the maintenance fee is. Now we're pretty much seeing they start right off the bat, $500 a month. And it gets $700 and it keeps going. That's some mortgage payments on its own if we were to look way back then. So what happened is Canadians, they added their debt load just by the way the interest rate has changed, right? Because now you just added another $1,000 or $2,000 into your monthly payments. It's just because the interest rate is high, right? Whereas before you didn't have that. So the cost of living was low. It was, house pricing was reasonable. Everything was in line. The proportions were reasonable. Now the proportions are off, So if you take the equation, your coefficient is really, really high.
Yeah.
So, but going back to buyers, you still have the investors, as I said, the ones who are financially in a good shape, right? And they've been smart with their money. They're looking for investments. It's an opportunity for them because if I'm having new income in, right, they're going to rent.
Yeah.
So now you find the Airbnbs. A lot of investors, they're looking, I'm going to turn my house into Airbnb and I'm going to just take one room.
Where's already clamped? Oh, yeah, they'll take
Right?
one room. Okay, there you go.
One
Yeah.
room, I'm going to rent, turn it into Airbnb. I'm making money, right? Or you have the ones that are like, oh, you know what? I have a basement. To Roland's point, it has an exit, so that's good. Or the ones who want to buy, they have money and they want to buy investment properties and build from there. Or the ones who want to go elsewhere, seize the opportunity to have another property and build their investment portfolio again in other countries, which before it wasn't the case. It was all in here. And you have the ones who are now coming up for renewal. That's just the ones who didn't do anything. It's just their mortgage is coming up for renewal. So yes, you have all these types of clients. The challenge is with the refinance equity takeout. So for the ones who aren't building equity or the ones who bought in the past, Roland, like 5 years, their equity did not really appreciate. Like there is, the margin is very tight, so they can't borrow on that, and they're tight financially. And you have the seniors as well.
Mm-hmm.
Who are downsized, and either they can buy cash and they're looking mostly outside of the major city because they're that's their retirement home, so they cash out, they sell, and they go and buy.
Yeah, let's just talk about something positive.
Positive.
Yeah.
So these are positive things. There are still clients, right?
But yeah, there is always a silver lining, by the way.
Yeah.
There is always a silver lining.
So like if you have a client 55 and over and they're thinking of moving out to different countries, investment or whatever, there is actually, they can get a mortgage without, not much mortgage, without any payment, called reverse mortgage simply. They don't pay a penny, cash out a little bit of their house and go put money somewhere else and buy a house. For example, like last time that we were in Arizona, his house, it was like $450,000 for a probably 2,800 square feet house, big house.
Mm-hmm.
It was amazing.
That's great.
It was amazing.
Yeah. And the weather, right? Because as I said, people got tired. They're looking for better weather.
So people will do a reverse mortgage and then move south.
Yeah, they do.
Yeah.
A lot of 55 and older that they quit, like what I did.
Yeah.
They retired simply.
Yes.
They're using their equity.
As vacation home, like they still live.
Go somewhere
but
else
they go
and buy
back
a
and
house.
forth, right?
Yeah. So they
don't-
rent out their current home, do a reverse
Yeah.
mortgage, and
No, they don't rent. They live, like the primary residence is still here,
okay.
and they will do the reverse mortgage to purchase a property somewhere else, right? That's very helpful to them because they don't have to worry about the mortgage payment.
That's easy mortgage money without qualification.
Yeah.
Yeah.
That's very easy money to get.
The older you are, you can unlock more from your equity. So
Oh, wow.
yeah. And it's a very good, they're not required to make any payment as long as they live in the property. So it's their primary residence, but they can use the funds to pay for their grandkids' university, acquire another property like somewhere else where they can go and spend some time.
Right.
Yeah.
And that's
Yeah.
farther.
Yeah.
Right.
And
And
still you're
it's-
paying the money.
And it's still expensive, right? So this is why I think a lot of people are looking at options like that, where
We can arrange some presentation. For instance, if you have a group of, investors who want like specific to certain
Yeah.
area within the state, we can, customize the presentation for them, give them the information they need for that specific